So JP Morgan is selling products that put their clients at risk and risk their reputation. I don't think so, homie. Well, that was my favorite comment from the video I put up a couple days ago. I'm going to talk about that a little bit more. So, hello friends, and welcome to another video by The Rational Investor. My name is Adam Kahn. I'm on my walk today. Let's talk about that a bit when we get back. Good morning. My name is Adam Kahn. I'm the Rational Investor. Taking you along on my walk. I'm hoping the rain doesn't come because looks pretty cloudy, but we'll see if it holds up. It's Vegas. Sometimes it looks like that and then goes away, but maybe I get rained on. Anyway, so I had a comment on a video that I put up on JEPI and JEPQ is what I'm assuming they're referring to because they were talking about JP Morgan. But before I get into that, do me a favor, if you haven't already, subscribe to the channel, give a thumbs up, make some comments. I really like the discussions. And even the person who made the comment on this, like really, I appreciate the comments and I like the discussions. It's how we all learn. So it's super cool. The other thing is I'm going to put a link in the discussion on opening an account at SoFi. Not only do I own stock in SoFi, I opened an account there as well. It's the one that if you click on the link, you guys get a gift, I think $25 if you deposit $10 or more. And then it gives a gift to the account that I opened. And I opened it with my 13-year-old son. He and I try to, I try to teach him about investing as well. So it helps with that. He gets really excited. So now let's talk about this. Do I think that JP Morgan or any of the companies, I don't want to pick on JP Morgan in particular, put their clients at risk? Probably not. But I don't think their clients' best interests are their best interests. I think the goals of these companies is to make as much money as they can for themselves and their shareholders. When I was in college, I thought that I wanted to be a stockbroker. So I started doing internships at Merrill Lynch. The only thing I learned is it really wasn't what I wanted to do. What I learned was the brokers didn't do a ton of research. The company essentially put flyers on the desk of the companies that they should call their clients and tell them to buy, and gave them all sorts of hypothetical questions and ways to answer those questions, and kind of train them on how to be salespeople. But I always liked the markets. I wanted to study them. I wanted to invest in them. Probably even wanted to trade in them, which is what I eventually ended up doing. And when I went and worked at Merrill, I was super disappointed to see what really went on. The only thing that experience really did for me is it made me realize that wasn't what I wanted to do. And the way that I see that these companies have changed over the years is they don't really give a prospectus on the companies they think that their employees should sell, but they push them to sell their funds. And this is just a guess. I'm guessing they get a bonus depending on how much of it they sell. Well, if you're that company and you make money by people being in the fund, it's probably good if your clients are investing in your own fund. And it also avoids lawsuits because from their perspective, they're professionally managed, they have the right disclosures, they're diversified, and everything else. My point in these funds are not that they're putting their clients at risk. My point was, by definition, they're likely to underperform the market. They have a little bit risk to the downs, a little bit less risk to the downside, because when you sell the calls, you're going to collect some premium. So if the market goes lower, instead of the full loss, you'll pick up the small percentage of the call sales. But you're still exposed to the downside risk and you limit your upside potential. I just don't love those funds. But keep in mind the companies you're investing at and their ultimate goals. Like, I don't know that they're out there doing the best that they can for their clients or hoping that their clients don't complain and covering themselves enough to make sure that there are no lawsuits. I don't want to overstate it. They don't want to do bad for their clients either. But I think their ultimate goal is to have corporate profits go up so that share stock prices go higher and shareholder equity increases, as well as their own profits and margins. And if the customers make money in the meantime, that's great. But they don't make as much money if you go through the fund and buy all those stocks and leave it and don't do anything with it. If it just sits in an account, sure, they've got the equity there and they can use that potentially to lend out to somebody else, but they're not making those extra basis points, and the market and that account is just sitting. It's not active. By all means, like I always say, you guys need to do your own research and find the products that fit you best for your financial investments. And you shouldn't be listening to me, or for that matter, any YouTuber or anybody else. You need to do the research to see what works and what's important and what makes sense. And every investment product has a reason for it. I'm just suggesting that people pay better attention. There's so many people on YouTube talking about tsly, JEPI, JEPQ, and all these other high yield funds that may or may not be the best investment tools. Maybe they work for you, maybe they are, but take a deep look into them and see if it makes sense, because a lot of them are going to underperform overall. And some of them, like tsly, from what I read in the prospectus, it takes a lot of risk. It's essentially an options trading fund that's giving out dividends from the out of the money calls they sell against synthetic longs. My guess is a lot of people are seeing the yields and thinking, God, that's a great investment, I should do that. And then they trust that since it's a fund, it must be something good and they know what they're doing. Well, I was a trader for a long time, and I got to tell you, I don't know that these guys always know what they're doing. They're trying to raise money for their funds and find products that people find attractive. Doesn't necessarily mean that they're trading them great, and maybe they are. Like, I'm not saying anything about they're wonderful, they're not wonderful. I'm just suggesting you look into it a little bit before listening to the YouTubes talking about the yields on them, because I'm listening to one guy who takes on margin debt because of dividend payments that Cornerstone pays, invests in a tsly, puts a large amount because of the yield it's getting, and kind of talks about it in a way that he implies that those yields are guaranteed. And then he uses the dividends to pay off the margin debt, showing how that's building his wealth. Well, that's great as long as it works. I don't mean that sarcastically, like really. It's great if it works, but if something's paying off an extremely high dividend rate, there's a reason for that. There's risk they're taking on. Maybe it's understood, maybe it isn't. I'm just worried that people investing in these things don't really understand the risks. Now, if you understand what you're putting on and you're comfortable with it, by all means, I think that's awesome. It's another tool to use. I don't see any problem with any of it. If you have the right percentage of your portfolio in different things, they all make sense for different reasons. Just don't be tricked into it because some YouTuber is saying what a great idea this or that is. Part of the reason I pick individual stocks is I understand what they are. I know what's in them. If I buy Target, I know what that is. If I buy Amazon, for the most part, I know what that is. Now, they've bought a zillion other companies along with Meta and Google and everything else, but at least I understand the companies, what they own, how they make money, and have some general idea what I'm buying. If you're buying these funds without really knowing what they do, simply because you see a high dividend return, I suggest doing a little bit more research. Look at the prospectus, see what it is, learn a little bit about what a covered call strategy really is, and decide if that's what you want out of that investment. I would rather own Target at $130 or $140 a share, and if I want a covered call, geez, I can look out to the January $220 call and pick up an extra $1, which is like an extra dividend check, so that I feel like instead of 4 in the year, I'll get 5. And if the stock goes above the 220 strike price by next January, well, I've committed to selling my stock at 220, and I'm pretty good with a return of buying the stock at 140 and selling it at 220 in a year. And at the same time, I have no plans on selling the stock. So if it doesn't do that, and it meanders or goes up a little or down, well, I get 5 dividends instead of 4. That's just how I look at it. But I'm much more comfortable with that. Or if I want to trade, for me to trade for myself, then have a fund that does it for me, where I don't really trust their skill set or whatever algorithm they're using, along with the fees that they charge. I'm a little careful about them, and that's not the products I want to be buying for myself. It's the only thing I really know. The more hands in the pot, the more people getting paid. So I really don't mean to pick on the guy who made the comment. And again, I really appreciate the comment. But yes, I think these companies don't have the best interests of their clients. They have the best interests of themselves. I don't think they're going to take legal risk. So I don't think they're going to do anything that puts them in jeopardy. But I sure don't think they're going to create the absolute best investment product to meet the needs of the clients. I just don't think they're that altruistic. I think what their goal is to make attractive products that they think the clients are going to find attractive, so that their employees have the best chance of selling them. And what they've learned of recent is people are attracted to dividends and yield, so that's attractive. Just keep in mind, I don't financially benefit or not benefit whether you buy those funds or not, which is why I keep saying, do your own research, decide what you want. I bought them as well. I'm attracted to dividends and yield. And then I read the prospectus and thought, geez, I don't know that this is what I really want. I'd rather just own the stocks. Now, that's just me. That was my decision. And again, don't follow me. But take 20 or 30 minutes. It's not that hard. And if you have questions, just ask. I'm happy to talk about what I think about them. I mean, obviously, that's why I'm doing the channel. And then decide from there what fits your portfolios. Just my thoughts on it. I don't know. Maybe they do. So again, before I forget, do me a favor and hit that subscribe button. Make some comments. If you want, smash the like button. You know, I really do appreciate. We built up to over 2,000 subscribers. Woo! I'm really excited. It's cool. And I'm enjoying it. And still hoping I don't get rained on today. So have a great day. Have a great weekend. I'm sure I'll chime in. I'll probably do my review on my portfolio either Sunday or Monday, because Monday the markets are closed for Christmas. And I got family visiting, but I'm sure I'll want some time to get to the camera and say hello.